VC Wisdom Pod with Sumeet Shah. He's founder and managing partner at VHS Ventures. Has a very colorful background. We're going to discuss about that today. Before we do, Summit, or Summit, that's a cool nickname, by the way, Summit.
Yeah.
Sumeet, can you introduce yourself? Tell us a bit more about VHS.
Thanks, Charles. Not surprisingly, with my name, I get like a billion nicknames. So I've always had that case ever since since school. That might have to be another episode, I guess, for listing all of them. Thanks for having me on, Charles. I'm Sumeet Shah. I'm the founder and managing partner at VHS Ventures. As you mentioned, we're an a brand new early stage consumer focused venture capital firm doing seed, Series A, and pre-seed investments in the next generation of consumer founders. We're doing seed checks in a mixture between consumer brands and consumer infrastructure startups. Infrastructure defined as tech-enabled platforms that help the business models of these brands, so supply chain, inventory, logistics, experiential retail, data analytics, etc. And consumer brands, pretty straightforward, but all subsectors, including food, beverage, CPG, health, beauty, wellness, and apparel and accessories. My whole background comes from 15 years of early stage and late stage consumer investing and operations. First 5 years of my career across the world of private equity on the consulting angle, and then the last 10 years across startups and helping to start and manage two early stage consumer venture capital firms, Brand Foundry in 2014 and SwiftArt in 2019.
If I'd have like one word to describe it, would be like high achiever. I mean, that's two by definition, but tell me about your background. Like, why are you that way? You seem like to be always scaling Mount Everest after Mount Everest.
It's funny that you use high achiever as the one word. I would actually replace it with masochist. But I guess
I'm that way too, by the way. So we're two.
Yeah. Well, cheers to that. Happy to build this club here. Maybe we can call this episode the Masochist Club.
Yeah.
But in all seriousness, I've really just been an eternally curious person. I graduated from college in 2008, which was a very, very great year to be graduating as a biomedical engineer focused in biomechanics. And I was actually really wanting to focus on the finance side in healthcare, really working in the healthcare venture capital world, like really helping founders and entrepreneurs grow, and especially just for the opportunities to succeed. And I had gotten this opportunity to interview at, and then ultimately got the opportunity to join this consulting firm across the private equity world, at that time called Gotham Consulting Partners. And it was such an intriguing industry to me because of how much of a shadow industry it was to it. And so when I joined, things were riding high. And then, of course, literally in the final months of my year at college, everything came crashing down with the global financial crisis. I watched about 2/3 of my friends lose their jobs, about 2/3 of those get hired by Teach for America, and somehow I kept my job. It was just more, though, trying to save sinking ships. And so if you really wanted more eye of the storm experience about what was going on, that was it. And out of those ashes, while I was working with a lot of industrial companies at the time, you started to see this really large turn towards the consumer world. You had the launches of these direct consumer brands and stalwarts like Warby Parker, Birchbox, Harry's, Peloton, Oscar, Casper,
Hims.
Lyft, Uber, Hims was actually a little bit later. We're talking about 2010, 2011 timeframe. So all of these just eponymous brands that all started at this time frame, Dollar Shave Club, even
Harry.
I'm sorry,
the razors.
Yeah, Harry's
Yeah.
the same time, and Harry's came a little bit after Warby Parker as well, because Jeff Rader was one of the original co-founders of Harry's. And so you start to see all this, but you also started to see a lot of new early stage consumer investment firms. So Kirsten Green, who was an equity research analyst at Bank of America, started Forerunner in 2012. You had Ken Lehrer and Ben Lehrer start Lehrer Ventures, soon to be later Lehrer Hippo Ventures, in the early 2010s as well. And you just started to see a lot of these like early shops that were eponymous in investing in consumer and were experienced from it, start from there as well. And so in 2011, I started talking with a few of those firms as well. Mike Duda ran a firm called Consigliere Brand Capital, which was an ad agency and venture capital hybrid. That firm today has now been rebranded and known as Bullish. And so he reached out in 2011 as well to connect. And so I sat down with him and a colleague of his, Andrew Mitchell, who was an angel investor, and we just all clicked. And I was always just curious about the world of consumer as I was transitioning towards working a lot of that in the private equity world, especially just for the number of gears that really intertwine from it, how customer centric it is, and how volatile it can feel, but also how just uniquely interesting it is that you have to keep learning and growing and evolving with your customer, with your clients, with your people from there. And, you know, it's that level of experience and expertise that you have to create that customer service perspective that always just intrigued me in general from it, and just the general relationship you build from it. And so connected with them in 2011, stayed in touch. 2013, I moved into the startup world, joining a mobile and app development studio, helping them with some new business. And Andrew had reached back out, as did Mike. But Andrew also was in the final stages of putting together what would be Brand Foundry, and brought me on in early 2014 as a senior associate. And we officially launched the firm in March of 2014. So it was exciting times. We had a few companies that we rolled out with, one of them being the outdoor gear brand known as Cotopaxi, which today is doing 9 figures in revenue, is owned primarily by Bain Capital through their ESG fund. And it was a very exciting time, to say the least, from there. And we ended up investing in 20 deals over 2 funds when I was there. And companies you might know like Koyo, The Wing, Rockets of Awesome, Allbirds, seed and Series A of them. We led seed rounds for companies like Yumi, this baby food startup that's also doing about 9 figures. The Sill, a major plant startup. Both of the companies I helped source, actually I sourced. And really just getting that opportunity to go deeper from this. But you watch the evolution from like any investment ecosystem, from the early adopters to the later stage, the late adopters, I should say, non-consumer investors that were investing in not primarily for real, scalable, sustainable, structural growth, like we talked about earlier. It was more of the growth at all costs model. And that were just what they were experienced with, investing in tech and SaaS, which is fair and fine, but it just does not work for an asset-heavy industry like consumer. Well, then you had the Aways and Glossiers and Outdoor Voices and Sweet Greens, even Allbirds that launched at the time. And you just had a lot of later investors, larger investors that were coming in, floating up and blowing up the valuations. And you just had basically this large object that was headed straight for a brick wall. And the brick wall ended up becoming COVID. You had mass reset where a lot of those non-consumer investors are gone now. They've all moved on to the next big thing. A lot of the original consumer investors that started out, they all have much larger funds now, 100, 200, $300 million funds. I mean, the last fund size for Forerunner, for example, was $1 billion. Not all of them are able to either get into the early stages of consumer or even just get involved with the space. Like they have to expand across other sectors and subsectors. And during that time, I was helping to launch and ultimately launched SwiftArc Ventures, early stage consumer and healthcare VC firm, building out its investment strategy, its fundraising, its platform, its operations, but also just like watching also kind of from the sidelines, like what was going on with this industry. And there was in very much need of that reset. And so now, coming out of the ashes of a new crisis, which a global pandemic, now how our consumer startups really growing again. It's very much a back to basics opportunity where you can again focus on careful, sustainable, scalable growth from there. So it's an exciting time. And while that's my entire growth into all of this, it's really fueled my eternal curiosity because again, I'd be very curious. I was always just mindful about what companies were just really leaning on their communities, especially even coming through with COVID. And the ones that truly were successful to it coming out of the peak of the pandemic were the ones that are truly successful now and are going out to raise capital and honestly have incredible futures ahead of them. So that's what's kept me driving forward, whether it's in this work world, everything else that I'm involved with personally. I just grew up in a culture that was all driven towards it.
Interesting. Yeah. That last one liner was like the answer to the question, but thank you for the whole bio. And you and I would probably need a couple of these episodes to get like through all the teams. But first question, you mentioned that some of these, I call them BTC startups or marketplace or whatever you want to call them, are emerging victorious. Do you have example of these? And then the second question, is it like truly scalable like software? My first startup was Nootropic, and we put that one down to the ground. We didn't like really go through the VC stuff. And back in Canada, there's not a lot of support, but the physical business meant, yeah, we needed production, we needed shipping, we had these headaches left and right, we had inventory. So there's all these counter currents that SaaS doesn't normally have. So can it scale the same way? Is there the trend where people are all about SaaS nowadays, and that means less competition in that area? And how can I compete against Nestle? So there's like 5 questions in one, but let's start with examples of startups that emerge victorious on the other side, and then can it scale next to SaaS?
Yeah, so I think about brands like Harry's and Warby Parker. Well, they haven't been entirely successful in the public markets from things while they've lost significant shareholder value. The companies at least have been successful being able to grow enough to get to the public markets and be eponymous brands even today, right? When I think about Warby Parker's market share compared to the absolute behemoth that is Luxottica, or Harry's market share compared to Gillette, Schick, etc., it's a perspective where they will never need to ultimately like control that market from it, just because they just absolutely can't. You're not going to compete against a brand backed by the Unilevers or P&Gs or even, of course, multi-billion-dollar shops on its own self, like Luxottica. But all you need to really do is build a really good brand recognition strategy, a mixture between the discovery and retention that becomes such a sticky ethos to it, right? I mean, there's the story that like people know Warby Parker for what it is, and the fact that you also have companies that have been built in the shadow of Warby themselves, how they continue to evolve in the space. But there was a survey done not too long ago by the founders, and that like 50% of the people they surveyed had no idea that Warby Parker existed, but when they learned more about it, there was a much higher conversion for them to be like, of course, I would definitely consider something like this, versus like going to a local eyewear optician, and why would I spend 3-4 times as much from the product? And so ultimately, brands like them, brands like brands like Monos in the shadows of Away, that were much more focused on careful growth and are doing quite well. They're still doing 8 to 9 figures of revenue today. And also the ones that have continued to grow, even to get investments from the consumer-focused private equity or growth equity firms that they've been very successful at. And like, there's still ones that are also doing around 8 figures in revenue, but are much stronger foundations from that. I can list various brands like companies like Buck Mason, companies like Huckberry on the marketplace side of things, companies like Fly by Jing in the food and beverage side of things that is doing 8 figures of revenue and scaled out to raise growth equity firms. And going back to the purpose of the scale that you're asking about, Charles, is Lawrence Linehan, who was a longtime VC investor, said we shouldn't think about the idea of the billion-dollar brand. The target of a success metric should be about top-line revenue for a consumer brand, and was really about 50 to 200 million in this 5 years of operation. Now, it's a great data point for a very successful brand that could really be in control of its entire destiny. But I think today there's a bigger opportunity of scale where it's even like 10 to 25 or even like 5 to 25 of million of top line revenue. It's all about also internally like how you do as a business. Like 5 million in top line revenue and profitable, or even just break even, is successful to its own metric. But you're not actually going to be swallowed up by competition. You might have actual real opportunities for end growth from there as well, like a pure acquisition, a pure bolt-on acquisition by a private equity backed company. But to me, originally that 50 to 200 million was the level of like true scale and the goal for it and the summit for it. But I'm really excited, especially about like where that 10 to 25 is ultimately going to be in terms of success. Like, and all of this just again relies on growing through your community carefully and almost like a concentric circle kind of way. Like there's the mentality that I call the blast wave radius, where you focus on your initial growth of customers, ones that you're leaning through, you're learning from, you're trying to build a good retention strategy, or depending on the kind of company, build stronger ambassadors within them. Like if you're selling mattresses, you're not focusing on retention, you're focusing more on growth, on ambassadorship between them. But of course, if you're like a basics company or a food and beverage startup, you're looking more on that retention side of things. You're just looking really to build that level of stickiness, and that stickiness will ultimately determine the summit of a company itself.
Right. And through the original question, SaaS vs product, because we've seen Casper somewhat failed. We've seen bonobos. The thesis behind these startups is to infuse a physical product with tech. So that's their advantage, because most of the product are like brick and mortar family owned business. It's kind of to inject the tech that brought Silicon Valley SaaS to the stratosphere, in the hopes that we can reproduce that with products. Products are more perennial. The advantage is more solid once you have it, but the costs are higher and the flexibility is less. You can't really pivot on an inventory. So what would you recommend young founders? For example, another silly example, my wife's cousin, like she's in Mexico, she's selling cakes, right? And I was like thinking to and today she got a job as a waiter, because like it couldn't scale, there was a lot of cost, and you need to walk and sell these things. While my wife, for example, well, she offers services, so from day one there's profitability. So like, what would you advise founders? Is there still an opportunity in that space, building a physical product vs starting at a service and then SaaSifying that service?
Mm-hmm. So when you mentioned companies like Casper and Bonobos, and they were successful in their own kind of ways, that again, getting to the public markets and ultimately Casper selling to one of the large mattress companies, but also even Bonobos growing and selling, of course, to Walmart. And while the deal ended up not being so great, they still ended up selling it to the parent company of Express. And Andy Dunn is actually back in advising the company today. There still are success metrics in terms of the company's end goal for the early investors. But when we talk about tech for it, the reason why those companies were successful with a tech-enabled feature to it is because the tech wasn't at the forefront of the company. It was more of the fact that it was this invisible, almost magical system that helped the company grow, whether it was with Bonobos, doing its original fitting and learning basically from a person's general body type and products. They were able to use that combined with what products that people they were saving with their profile to recommend and just build wardrobes basically for people. For Casper, the tech itself wasn't really so much about the tech, if anything, was just the marketing. It was just the actual delivery mechanism, right? That was not very unique. That was definitely had a very low barrier to entry, but it worked because it just leaned on that level of efficiency and time effectiveness and just and connecting with those customers to there as well. And look, it was a product that had a very high average order value, but a very, very close to same quantity amount of the lifetime value, because people were not going to buy a mattress, the next year, obviously, but they lean on the opportunity for people to be like, hey, if you're ever looking for a mattress, just go with Casper, when people were actually asking from it. And that was the whole purpose for them, was just building a better marketing tool. And sure, like maybe getting people to buy pillows and buy like other key products that Casper built out for its ethos, but that was not the ultimate goal. And so a successful consumer brand, if you are going to be looking at things like tech, it has to be a channel, not an absolute. There was a danger where Everlane and Sweetgreen during that lifestyle brand boom, like the mid 2010s, they turned around and started saying like, "Oh, we're tech companies." I'm like, "No, you're not. You make salads. You make clothes. Like the tech is the magic behind it that helps you guys, helps your customers, like with in terms of reordering, in terms of recommending new products, in terms of learning with your customers. Sure, that's great, but do not say you're a tech company. Like you're only saying that just to appease potential new investors, which makes it actually more dangerous because those investors won't actually have the right mindset for growth.
Right. And we saw that in the case of WeWork too.
Yeah.
I guess, like potential answer, because most entrepreneurs, I mean, in my time, new kids on the block might be different, but we still started businesses selling t-shirts, and
Yeah.
mowing lawns. And I mean, that service, you still need a lawnmower and a car and gas and so forth. So start like doing, I guess, what you know, because I mean, you're not born out of the crib knowing how to sell a website or building an app, for example. But yeah, like slowly but surely acquire experience in those fields, because service-based businesses, you can be profitable from day one. And then the challenge, which does take a while, is kind of sassifying that. Um, I guess Sumit will do another episode because I mean there's more to cover. There's the boxing, there's your own firm,
Yeah.
and then I have many questions. Like your career so far, like and about Clear. Like what was your experience there and so forth. So we'll stop the episode there, but tell us where we can get more info about you.
Yeah. So for now, you could definitely follow me on Twitter at PE_FEEDS at PE Feeds. I'm going to drop a link in the chat here to Charles, which is a quick link tree that can also just find out more about myself, VHS Ventures. And more importantly, and for those asking, I'm not on Threads yet. We'll see whether I get on Threads. I just haven't had a real use to get there yet, but like anything, like any good investor, I'm waiting for some good development and traction. And as any good consumer investor will tell you, number of clicks and number of traffic does not actually constitute sales. So we'll get there. But anyway, I just dropped the link for Charles, so you can put that in the episode notes.